Okay, good afternoon, everyone, and thank you very much for attending this first CMC Options webinar. Today, I'm also joined by Jawaz. He's a client services executive, and he's gonna answer questions alongside me as well. And my name is Lukas. I joined CMC to help bring options to CMC clients like you. And today I aim to make a product which is often considered very complex, more approachable and intuitive. Any feedback will be welcome, and we also look to address questions that you may have. And these questions and your feedback and inputs will also help us shape the future webinars. And please remember that this webinar is for educational purposes. It's not meant for marketing. And please consider whether you understand CFDs, spread bets, and OTC options and how they work, and whether you can take the risk of losing your money. Before we discuss options themselves, we'll revisit what a CFD or a spread bet is. A CFD provides exposure. This exposure is symmetrical, and this means if I buy a CFD or a spread bet, and the underlying asset price goes up, I make money. But if the underlying price goes down, I equally lose money. And because of the leverage, which is included in these products, this also means that the profits, but also the losses are amplified. So now, what can we do to manage the risk? And the first tool that we discuss here is the guaranteed stop loss order, also called GSLO. This tool is used for risk management, and it ensures an exit at the specified price, regardless of volatility, slippage, or any price gaps. But to reduce the risk, a client needs to pay a guaranteed stop loss order premium. This premium, however, is refunded should the GSLO not be triggered. I think it's best to look at an example to really understand how it works. So assuming that the Tesla stock is currently at $440 and I buy 10 units, I want to protect myself on the downside. And so I add a GSLO with a level of 420 to that. In this case, the premium for the GSLO would be $2.20 per unit, which is a total of $22 for the 10 units that I buy. And the commissions here would be $10 per transaction, which is a total of $20 if I first buy and then close a position. Looking at the scenarios, the first one would be the ideal one or the best one for clients here, which is when the Tesla stock rises, for example, to $460. The profit here would be $180, which is calculated by the difference in the price. So 460 minus 440, and then multiplied by the numbers of unit. But because we mentioned that we will need to pay commissions as well, we need to deduct $20 to then get to the $180. The GSLO premium in this case would not be charged because the GSLO was not triggered. If the Tesla stock drops down to $400, however, then the GSLO would come into play. And instead of selling at $400, this order would trigger at a price of $420. This leads to a maximum loss of $242, which is made up of $200 price difference between the 440 where we started and the 420 GSLO level. Then we need to add the GSLO premium to that, which was $22, but also the commissions. And let's put this into perspective. If we didn't have a GSLO, we would have lost $400 overall because we would have sold at 400, and then we would also need to add the commissions to that. Then what happens if the Tesla stocks stay around here at 440? In that case, we would only lose the commissions if we close the position. And this is now one way to manage the risk, but we now discuss options, which is another way of implementing a very similar exposure where we have upside, but limit the downside exposure. So what is an option? Remember I mentioned that the payoff for CFDs and spread bets are symmetrical. I lose money when the prices go down and make money when prices go up. For options, the payoff is asymmetrical. The buyer has the right, but not the obligation, to buy or sell an underlying asset at a specific price, which is called the strike price, by a specific date, which is the expiration date. The sellers, on the other hand, would have the obligation to fulfill the contract terms. Today, however, we focus on just buying options, even though we could technically buy or sell at CMC as well. There's two types of options, one of them call options and the other one put options. A call option, if I buy a call option, then I benefit from rising prices because it provides me with the right to buy an underlying asset at a specific strike price. And in the case of cash settled options, instead of buying the asset physically, I would get a cash difference between the strike and the settlement price. We will look at it in some examples in more detail. Then for put options, I have the right to sell the underlying asset at the strike price. And here I benefit from falling prices. So this is a bit similar like buying a CFD or spread bet and selling a CFD or spread bet. Because on the left side here, I benefit from rising prices, and on the right side here, with put options from falling prices. What options do we offer at CMC? We currently cover indices, 9 indices in the US and in Europe, as well as the Magnificent 7 stocks, including Tesla, Nvidia, etc. And we're working hard to add more assets. Then in terms of expiration and strikes, we offer monthly, weekly, and daily options. These also include the zero-day options, which have been very popular. And we also offer a wide range of strikes. And if there's anything that you think is missing, then please reach out to Jowas and team. So we are always happy to review whether we can add further instruments. The option style is European style. This means that options can't be exercised during the term, but only at expiry, and the settlement happens automatically. The exercise happens automatically. The options are cash settled, so there will be the difference between the settlement price and the strike price, and this payment will happen a net of premium. With regards to costs, there will be the bid-ask spread, which is the difference between the buy and the sell price. There won't be any commissions. There are no holding costs compared to CFD and spread bets, but the same currency conversion cost would apply here when the instrument currency is different from the account currency. We offer fractional trading. You can buy or sell options from as little as 0.01 contracts, and one option refers to one underlying asset. So we have the opportunity here to implement a very exact exposure, or can also trade in very small sizes. Please note that the hours for options, even though the underlying assets are the same as we have in CFDs and spread bets, the hours sometimes differ. So you can find all the details in the product overview. And again, please reach out if you have any questions. When we discuss options, we often come across a payoff chart. A payoff chart is a graph that shows the relationship between an option price and the underlying price at the expiration date. Here you can see on the x-axis the underlying price at expiration, and on the y-axis the options P&L. Then the red part here shows when we are losing money, and the green part where we are profiting. And here on the left side we see 420 in this example, which would be the strike price, and the break-even price is 400 423.85. The break-even price shows us how far the underlying price needs to increase until we break even on the position and stop losing money. And this is calculated by adding the premium amount to the strike price. The premium amount is calculated by multiplying the number of units, which we see here, by the buy price, here 385. And this is now the order ticket, which you see before an order is executed. So these are indicative levels, and what the actual break-even will be decided once the order is filled and you see the execution price and the actual premium that you need to pay. And with options, the big advantage is that you have a lot of flexibility. So we can actually first I need to talk about moneyness. So when we look at the payoff chart, we also often refer to in the money, out of the money, or at the money. And in the money means that an option payoff is favorable for a client, and out of the money it would be that it's unfavorable for a holder of an option. In the case of this long call that we see here, that would mean that whenever the underlying price is above the strike of 420, we would be in the money. If we're below that, we would be out of the money. And if we just run here, we would call it at the money. We first look at an example of an at the money option. We go back to the same example of Tesla stock being at $440. And here the client buys 10 Tesla at the money calls with a strike of 440. The expiration date is 1 week from here, and we need to pay $10 per contract. So the total option premium would be $100. And in this example, the client holds the option until expiry. Then we look at the scenarios here. The most favorable scenario here would be if the stock goes to $460 or higher. And at $460, the profit would be the $200 in the money amount, which we calculate by deducting the strike price from the stock price at expiry and multiply it by 10. And unlike for the GSLO, where we don't need to pay the GSLO premium if the scenario is unfavorable, we will always have to pay the premium. So we need to deduct it here as well. And the result, the client would have a net profit of $100. And again, when we go back to the example of the break-even, we see that the stock price needs to go all the way to 450 until we break even. But if the price only goes to 445, as here, then we would still lose money. In this case, even though we are $50 in the money, we would still need to pay the premium, which results in net loss of $50. If the Tesla stock stays just around here at 440, then the maximum loss would be $100 that we will need to pay because the premium is still charged. But if the price of the stock drops way, way lower, all the way to 400 in this example, we will still not pay more than $100. So this is now an at the money option. And we can change the risk profile and customize the payoff by choosing a different strike, choosing a different expiry, etc. So let's look at how an in the money option would look like. So here we choose an in the money option where the stock again is at 440 to start with, but with a strike of $420, that will be in the money. And because it's in the money, we would have to pay a higher premium. Here it would be $22 per unit, which results in a total premium paid of $220. When we look at the scenarios again, and the Tesla stock goes to $460, the option ends $400 in the money. And because we again need to pay the premium, which is $220, the net profit would be $180. Then if Tesla goes to 445, we now turn into a profit because the in-the-money amount is larger compared to the premium that we need to pay. However, if the stock drops to 400, we also have a higher loss than in the previous scenario or in the previous example with an at-the-money option, because the initial premium outlay was higher. And then if we stay around here, we would have a smaller loss because the option is already in the money by $200 and the premium paid is $220. So generally, we can select different strikes and can vary the risk profile, and we can decide how much risk we want to take and how much upside we want to have at expiration. But I don't need to wait until expiration as a client. I can also close a long options position or a short option position as well until then. This is very similar to how it works for CFDs and spread bets. CMC aims to always quote a bid, sell and a buy price, and these prices are then used to close an open position. In this example, we bought an option originally at $10, and then if the option price increases, let's assume that it goes to 15 at 15.45. So this is again the sell and the buy prices of an option. In that case, we would sell the option at 15 and realize a profit of 50. However, if the option price falls to $5 at 5.35, for example, then we would sell it at $5 and turn it into a loss of, or realize a loss of $50. I would like to add here as well that even though option prices are influenced by a big part by the underlying asset, there are also other factors that impact option price. And one of them would be volatility, but also time to expiry, which is a major one. And if the Tesla stock, for example, here in this example, just remains where it is and nothing else happens at all, this means that every day my option premium decays or erodes, and until expiry, then the option is worthless and I would have lost the full option premium. On the other side, we have the benefit that we don't worry so much about the underlying price going down very far, as long as it can go much further up again at expiration. So when we think again about the GSLO and the underlying price goes down to 400, then the GSLO would have been triggered and we don't have any position anymore. With an option, however, if the underlying price goes all the way down to 400, it just means that the option is very far out of the money and the likelihood that it will be in the money at expiration might be small, but we still have the opportunity to participate in the upside. So if the stock price recovers by the expiration time, we would still make money.